Gary Wagner here. It is Monday, approximately 9 a.m. in Honolulu, making it 2 o'clock in New York City, the 6th day of February 2012, and this is the Daily Report for Gold and Silver. We have a mixed bag today in that platinum and silver are trading higher, palladium and gold are trading lower. Gold is currently off about $5 on the day. As you can see, current print is around $17.20. Silver is up about 6 cents, and as you can see, current print on there, $33.67, $33.75 bid-ask spread. On today's show, I want to continue on the theme we talked about on Friday, and that is the possibility or potential of a small correction within the market at this point. If in fact that is going to happen, where might it go? Or have we seen the correction itself already come and go? We'll try to answer all those questions all here on today's Daily Report. Traders, the first market that I do want to cover this morning is going to be the gold market. Let's take a look at it through a couple of different focal points, daily and an intraday chart. We'll start with that. First of all, straightforward standard candlestick chart. This is a candlestick chart of spot gold. We talked about the fact that on Friday I was looking at a 2-day pattern. That pattern is typically called an engulfing bearish. It's an outside trading day. As you can see, you totally engulf the prior up day. This is the type of pattern that you look for after a extended rally and look at it as a potential reversal in the market that's indicating a pivot point or a turning point within the market. To take that call, you need what is called a confirming candle. A confirming candle is typically a large red candle with a lower high and a lower low. Now, as you can see, I'm just kind of drawing in on this. You've got a very, very small bodied candle, so we've met 2 of the 3 criteria. We absolutely have a lower low. We absolutely have a lower high. However, right now it certainly cannot be said that it is a long red candle yet. But 1, the day is still going, and 2, the fact that it's meeting 2 out of the 3 criteria, and the most important components are really that lower low. That's critical, and then of course the lower that low, the more credence it gives to this type of call. Let's take a look at the last time we had an engulfing bearish on a daily chart, and this is the high, the secondary high that we had in the market as it came down. This is our 1802 after we hit our record high. Market comes down, moves back up, and then hits a high, about 1760. But you can see right in here, we had an engulfing bearish, and then on the following day, if you take a look at that, it didn't meet any of the criteria. You did not get confirmation. You had a lower low, you had a lower high, but you had a green candle, and within that green candle, by the way, it was a small green candle. So you can see that although it didn't meet the criteria, on the following and subsequent market moves, we had a tremendous move to the downside, because here is where we saw this marketplace go to about 1550, 1540, somewhere in that area, and it didn't have that straightforward confirming candle. So just because we're not seeing that today doesn't mean that it will or will not happen. But I can tell you this, we want to be very, very cautious over the next few days, because my belief is that we're probably witnessing a corrective wave, meaning wave 2, this being wave 1. These are intermediate counts, of course. We'll get a wave 2, and then, of course, we'll get a wave 3. We'll have to see how that pans out. Second thing we want to do is look at this chart in terms of how it looks in Henkin format. And traders, I think you're going to find this very interesting, because you see when I convert this chart how different a standard candlestick chart is to a Henkin Ashi, especially in markets like this. Rather than an engulfing bearish, we got this doji, indicative of a market that's about to reverse. Open and close are about the same. Now realize they're picking the open in a Henkin Ashi as the midpoint of the prior day. And today which is a small candle, has a very large body when you look at it in the Henkin format. And so when you look at this market as it moved up and then look at this potential pivot point or reversal point, you can see that it is indicative of a market that has hit a top and is going to reverse. It is meeting the criteria. So I think that we are right in looking at that market right now in the way that we are. When we look at a weekly, and I'll go ahead and convert this into our weekly Henkin Ashi, you can see that on a weekly basis, all we're seeing is a shortened candle itself. It hasn't gone red yet. Realize weeklies are going to lag and the Henkins are going to lag. They're not going to be leading indicators. So we're not going to get the kind of information that we need right now from them. Therefore, let's take a look at this chart because I think that this is what's critical. It's a 360-minute intraday chart. It gives us more candles per day and thereby gives us more information. You can see that we've had these solid, even on the Henkin, we've had these solid red candles forming. As you know from our Friday's show, what I am currently looking at is the fact that we have probably gone wave 1 and we are probably in wave 2. Which beckons the following question. If in fact we are in a retracement, where could that retracement take us to? And of course, to do that, we really need to put up our Fibonacci retracement. Traders, I've gone ahead and done just that. I have created a Fibonacci retracement sequence or level starting from our bottom 1520, top 1763. You can see that 1706, it's our first level. We came close to that, but we haven't hit it. Next level is 1671. That's a 38% level. 61% is 1614. I typically don't look at the 50%, but I had an interesting email from one of our subscribers who had mentioned there is so much historical data going on in this particular area, meaning 1643. He felt it was relevant, and when I looked at the chart, there were some things I had to agree with. And one of the things is this most recent top right in here, 1643. You see how that matches up pretty eloquently. And then the other way to look at it is to simply put an extension to go backwards and look at history in that. And to do that, I'm simply going to extend to the left. And then when we do that, we can follow this 50 over. You've got, historically speaking, you've got an area right in here, but you also have one other area that happened some time ago, and that's this area right here. So you do have some historical data within this particular area that might warrant our attention. However, I really see a lot more history right in here. When I look at this, I look at this particular tops and bottoms. What I typically look for in a marketplace is a pivot point that's both support as well as resistance. And in that way, because it has been support and resistance, it tends to have a little bit more strength. And you can see some of these pivot points are extremely, extremely strong and thereby warrant some real attention. So where do I think the market's going to go? Well, if it's going to continue lower, our next target is going to be 1706, 38% level around 1670. Those are the two areas that I would look at. One other question I do want to answer that was requested by one of our subscribers, and that is, if in fact we are looking at a corrective wave 2, where can we look for corrective or impulse wave 3 to go? Now, in order to do that, we can do some forward modeling, but the key is this. The rule of thumb is regardless of where this goes, meaning the conclusion of corrective wave 2, when we get to wave 3, there are some straightforward rules we need to follow on our third wave. The first is which? The third wave can never be the smallest of any of the impulse waves. So, for wave 3, it is going to have a move that is going to be equal to at least the move that we saw in wave 1. It cannot be the smallest of any of the impulse, doesn't have to be the largest. We'll leave it at that, but hopefully the question has been answered. It's going to be at least the move that we have seen here. Traders, I wanted to spend a little bit of time on the silver market. Silver is actually up a couple of cents, a nickel to 6 cents higher. This is our daily chart. And when we look at our daily chart, you can see various levels that we have from this one Fibonacci retracement, but I do want to add one more. And traders, what I've added is one more retracement starting from the secondary high of $44 going to the same low. Why do I want to add it? Because what you'll see is that the 38%, 38.20, this 38% of this move here approximately, let me line that up a little bit better. As you can see, at this point, corresponds with the low that we got, as well as we can absolutely see support here and we can see resistance here. My sentiment is that silver will follow along suit with gold unless there are some new variables in the market. So that the fact that we're seeing support here, I think, is probably a tentative bottom, but I could be wrong. We'll have to take a look at it. But as you can see, we've got this doji-like candle, and what's very important on this is that once they hit this lows here, you absolutely had a good amount of buyers coming into the market to push it up and actually up on the day. It is something that's without a doubt worth noting. So what levels are we going to look at in terms of the upside? We believe that as this market came up, there can be no question. I believe that we've probably stalled within this area. And you can see you've got on a daily chart in the silver market, you do have an engulfing bearish. You've got a lower low, you've got a lower high, but you don't have a down day. So we're going to have to see where this market wants to go. But I can tell you this, it is my belief at this point that there's still a very, very strong possibility that we will enter some sort of a corrective stage. And that corrective stage, as I believe, is going to go either 1706, which we've gotten close to, but no cigar. If it goes and continues lower, 1671 in gold. But at any point, this is a bullish market. At any point, we could see a defined turnaround. We will have to keep our eyes and ears firmly implanted in the market. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.